What is the worst structure for a real estate investor? You're going to find out, and I guarantee you, it's going to shock you. All right, let's get started. Okay, so when it comes to real estate investing, what is the worst entity you can go out and set up immediately for your investing? Wait for it. It's a limited liability company. Now, I know this runs contrary to everything you've heard, and you watch my channel, you'll say, well, Clint, you talk about LLCs all the time. How can this be the worst entity I'm going to set up to own title to my real estate? Well, the reason why this is the worst entity you can start with is because everyone adopts the LLC as the beginning entity for all real estate investment types. And unless you know the types of investments that you're planning to take advantage of, then you could actually be screwing yourself up, meaning putting yourself in a position where that LLC is going to cost you more in taxes, reassessments on property, transfer tax issues that can come up. Or quite frankly, you'll just screw the entire deal up because when you go to sell, it's not set up in the entity that's going to make that sale attractive to an investor. So, what it really comes down to is that when you're investing in real estate, it's not so much about the entity. The worst mistake you can make is assuming that it's a one size fits all. What you need to look at is the type of investing that you're going to be engaging in. And the way I like to talk about this is I break up investors, basically my investments, into three categories. I have short term investing, which is less than 1 year. I have midterm, which is between 1 to 5 years. And then I have long term, which is over 5 years. Now, depending on what we're doing with the types of investments, that is it raw land? Is it going to be rental real estate? Is it going to be commercial real estate? We have to look at that. We also need to look at where you're acquiring the property. What states are you buying in? Because that's going to influence the type of entity we set up based upon how that state treats various entities when it comes to property transfers. And then what we want to know is how long we're going to hold the property, because what are the tax implications to us? So we want to make sure we're factoring all of this in. So if I'm looking at short term investing, that means 1 year or less. These are typically flipping activities. Maybe this is wholesaling over here. Anything that you're engaging in, either you don't own the property or you're only going to be in the property for a relatively short period of time because you're going to flip it, then with that type of structure, what we're going to be looking for is using a corporation. Now, you could set up a limited liability company, tax as a corporation, or you may want to set up a full on traditional Inc. So, with the short term investing and choosing the entity there, not only am I looking to ensure that I'm not tagged as a dealer and I have control over my income, that's where the corporation comes in. Because with the corporation, whenever you engage in dealer type activity or short term investment activity, wholesaling, this active income stuff, that income is not taxed down to you individually. It's run through your corporation. So if it's a C Corp, it's taxed to the C Corp. If it's an S Corp, it'll pass through to you, but it's going to come to you in a different manner than if it was just a partnership LLC or a disregarded limited liability company. And the thing about this is that we want to make sure that we're not looked at as a dealer by the IRS, because if we're a dealer, there's a lot of negative tax ramifications that come from that. Basically, no 1031 exchanges, no cost segregation, bonus depreciation, active income from all of our rents and everything we're generating from our investments. So we got to be really careful that we're monitoring what we're doing and putting the right entity in place. That's why we're not going to use an LLC here. We're going to use a corporation. More importantly, let's assume that you're an investor and you've spent some money to learn how to get into investing. Wouldn't you like to be able to ensure that if your investing doesn't work out, you can get a tax deduction for whatever investment you made to learn how to invest in real estate? There are a lot of real estate investors who go down this road. They don't ever end up investing in real estate, and then they find out that they cannot write off the cost of their education. Well, if you set up the right type of entity, a corporation, you can put yourself in a position to make that deduction if you shut that business entity down. So for short term, I'm going to go with a corporation in that structure. Now, the midterm stuff. So in midterm, this is where we're going to be looking at assets you plan to go in and rehab them, stabilize the asset, all right, increase its overall value and performance, and then you're going to sell it. And that's going to take you a while to do that. So in the midterm stuff, we're typically going to be looking at commercial or multifamily. Now, In this type of situation, because my primary motivation here is to get the property in a position where I can sell it and reap the profits from my work on that asset to increase its overall value, my number one goal is this: to make sure I can sell the property when I'm ready to get rid of it. So the entity that I'm going to choose here needs to be optimized so I can sell it at a later date. And what do I mean by that? Well, it's looking at what the buyer's lender is going to be focused on when you're selling property here. So in this type of scenario, what I like to do is I like to set up a partnership. I want an entity that's set up as a partnership here in this category, because that means I'm going to be filing a 1065 tax return. Now, some people will set up S corporations here as well, which you can do. Partnerships, I think, are preferable to the S Corp because during that time in which you own it, you want to be able to capitalize on all of the depreciation that you can flow out to yourself. And a partnership is going to allow you to do that more effectively than an S Corporation can. So you're going to set up a partnership or an S Corp, but the idea is you want to be filing a tax return for that entity. You see, there are certain entities like land trust and disregarded LLCs, which we use a lot for the longer term stuff, which I'm about to show you, that are optimized to not have to file returns. They give you all the pass through benefits of owning the real estate, the asset protection, the anonymity, but not the burden of filing multiple tax returns. This is one limited exception. When you're dealing with midterm stuff, we want to file tax returns. So in this structure, I'm going to be looking at an entity that's going to file a tax return because the buyer's lender wants to be able to verify the income and expenses on the property. Midterm, you're going to look at a partnership or an S Corp. Now we come over here to the long-term stuff. What we're going to be looking at there, this is our legacy investments, all right? This is the stuff you're holding long-term. So that could be single family, it could be multifamily, okay? It could even be commercial, it doesn't matter. Anything you intend to hold over 5 years and you're not going to turn around and sell, then what I want to do here is I'm going to be using land trusts and I'm going to be using limited liability companies as disregarded entities, okay, in this scenario. So these types of investments, as I talked about, I want to make sure that I have anonymity and I want to make sure I have asset protection, that all the assets are isolated. But more importantly, I want to make sure that it's all passing down to me so I can reap the benefits of owning these assets to wipe out my other income. So this is why I say the worst entity you can start with right away as a real estate investor is a limited liability company, because setting up the LLC first, if it's for real estate, you're really putting the cart before the horse, so to speak. What you need to do is analyze the type of investing you intend to engage in, then create the appropriate structure for that investing. Hey, there's lots of other things when it comes to real estate investing that you should be aware of. And if you want to learn more, I would like to invite you to my live tax and asset protection workshop. It's a free one-day event. There's a link in the show notes below. You can join that event. I'll be teaching you all about these types of entities, how to use them, when not to use them. And then we're going to show you how to save gobs of money on your tax returns as a real estate investor. Guys, it's completely free. I bring a team of attorneys and tax professionals with me to answer your individualized questions. I guarantee you'll leave that event in a better position than when you began. Look forward to seeing you there.